Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, here we go again. Every month we seem to talk about inflation right after the most current reading is announced. And once again, the inflation increased in June is higher. The inflation increase in June is higher than expected, with the CPI coming in at 9.1% year over year.
Wow.
It's the largest increase since 1981. Gas prices had the highest increase, shooting up 60% from June of last year. It's a big number.
It's a big number. You know, Steve, I can't wait until we can actually do an inflation video where we actually talk about inflation moderating instead of breaking records or being at multi-decade highs.
Can't agree more.
So with inflation running hot, all eyes once again turn back to the Fed. And people are questioning if the next rate hike will remain at that 0.75% that people are projecting, or will the Fed go higher because of the current inflation reading, maybe 1%. Futures at this point are predicting a 70% chance that the Fed goes 1% at the next meeting. So remember, the Fed's goal with these hikes is to slow demand, and slowing demand helps cool inflation. But the question then becomes, will they slow demand too much and push the economy into recession, or hiking until something breaks, as people call it?
Which they typically do.
Typically do, yeah.
Travis, the bond market is factoring in the chance of a steeper rate hike as the 2-year Treasury yield is at 3.14%, is higher than the 10-year Treasury yield at 2.9%. And that's an inverted yield curve. We've talked about this in the past, and an inverted yield curve generally precedes a recession. However, the recession could occur in the next few months, or it could be in the next few years. So it's really up in the air when the recession hits, if we even have one.
Yeah, you can't time a recession. And I just want to elaborate a little more on the inverted yield curve. So two-year rates are just more reflective of the current rate expectations. 10-year rates are reflective of future rate expectations. So expecting future rates to be lower than current rates is projecting what? Future rate cuts.
That's right.
And why would the Fed be cutting rates in the future? Typically to battle a recession, right? So markets are forward-looking mechanisms. So the current drawdown we're seeing is reflecting investor fear in a potential recession coming up.
Travis, and we tell clients, if you were positioned accordingly heading into this recession, now with the most recent pullback, you will have an opportunity to take advantage of these lower prices in the market, won't you?
Yeah, it's true, Steve. You know, we have the opportunity to buy both stocks and bonds at lower prices, or, you know, lower than we could at the beginning of the year. And additionally, if you have excess cash, you know, cash beyond your emergency funds and beyond the money you need to feel comfortable so you don't overreact, or your buffer, as I think we called it the buffer last week.
Yeah.
Now's the opportunity perhaps to put some of that to work. You know, we're still going to see volatility ahead. You can't get away from that with investing. And markets could continue to move lower as they work through all these issues that are happening in the world right now. But any good news could send markets higher from here, given the environment. And I think money invested today over the next 3, 5, or 10 years is going to be productive.
You know, Travis, you're absolutely right. I look forward to this next week.
Look forward to it as well.